Welcome back to the channel. Today, we are conducting an exhaustive deep dive into Tesla's latest financial performance and multi-year growth trajectory. From record revenue scaling to the intricacies of their delivery numbers and balance sheet health, we're breaking down the hard data that drives the world's leading EV manufacturer. If you're an investor or just interested in the future of energy and transport, this analysis is for you. Before we dig into the charts, please like this video and subscribe to the channel for more institutional grade market breakdowns. Let's get into the Tesla report. We begin with Tesla's current market standing on the NASDAQ. As of the latest reporting, TSLA is trading at $403.42, marking a steady start to the session. The 52-week range is particularly revealing, showing a spread from $214 up to nearly $500. This current price positioning suggests the stock has recovered significantly from its yearly lows, but remains in a period of consolidation relative to its peak. With a massive trading volume of over 54 million shares, the liquidity and intense market interest in Tesla continue to be a dominant force in the technology and automotive sectors. This market snapshot provides the essential context as we transition from price action into the fundamental financial statements. Understanding where the stock sits within its yearly range is vital as we analyze the underlying revenue and profit data that will likely dictate the next major leg of movement for this global market leader. Tesla's long-term revenue chart is a testament to one of the most aggressive scaling stories in corporate history. Starting from nearly zero in 2007, the company has grown its annual top line to over $25 billion in the most recent quarters. The visual data shows a definitive hockey stick growth curve, particularly accelerating from 2020 onward. For the full fiscal year, the 10-year compound annual growth rate, or CAGR, stands at a staggering 35.3%. Even in the shorter 1-year and 2-year windows, the company is maintaining its scale, though growth rates have naturally normalized relative to the explosive early-stage expansion. This consistent climb in quarterly revenue reflects Tesla's success in moving from a niche luxury player to a mass-market manufacturer. For investors, this chart isn't just about historical performance, it's the foundation of the thesis that Tesla can continue to capture market share across both the automotive and energy sectors as global electrification accelerates. Breaking down the top line, we see the diverse engines driving Tesla's revenue. While automotive revenue remains the primary contributor, the energy generation and storage segment is emerging as a powerful second pillar. The services and other segment also shows a steady contribution, reaching nearly $5 billion recently. Total quarterly revenue has consistently hovered between $20 and $30 billion over the last 2 years. The data shows that while automotive sales saw some quarterly variation in early 2025, the overall trend remains robust. The growth in the energy segment is particularly critical for long-term investors as it represents a key part of Tesla's mission to transition the world to sustainable energy. This segmental mix provides Tesla with a more resilient business model, capturing consumer spend not just on the initial vehicle purchase, but across the entire ecosystem of energy products and high-margin software and services. Vehicle deliveries are the lifeblood of Tesla's growth, and the data shows the continued dominance of the Model 3 and Model Y. In recent quarters, total deliveries have consistently exceeded 400,000 units, with the Model 3 and Y accounting for the vast majority of that volume. While we see a slight seasonal dip in the first quarter of 2025, the subsequent recovery in the third and fourth quarters highlights the company's ability to rebound and maintain its production efficiency. The other models segment, which includes the Model S, Model X, and Cybertruck, adds incremental volume and serves as a halo for the brand. Despite a 1-year CAGR of negative 15% in deliveries, reflecting a tougher macroeconomic environment, the 2-year trend shows a more stable story. For investors, the ability to maintain these high delivery numbers at scale is a primary indicator of Tesla's manufacturing prowess and its continued consumer appeal amid a growing field of EV competitors. EBITDA, or earnings before interest, taxes, depreciation, and amortization, provides a look at Tesla's core operational profitability. The historical chart shows a significant move into positive territory starting in late 2019, peaking at over $5 billion in early 2024. While we've seen some quarterly compression recently, with EBITDA dipping toward $3 billion in mid-2025, the long-term trajectory remains impressively positive. The 5-year CAGR for EBITDA stands at 18.5%, reflecting the company's transition from a cash-burning startup to a highly profitable industrial giant. The recent dip in operational earnings is a point of scrutiny for analysts, likely reflecting price cuts and increased R&D spending. However, the fact that Tesla remains billions of dollars in the black on an EBITDA basis, even during periods of heavy investment and market adjustments, underscores the fundamental strength and margin health of its business model compared to traditional legacy automakers and newer EV entrants. Net income provides the final word on Tesla's bottom line profitability. After years of losses, the company established a definitive streak of positive net income starting in 2020. The chart shows a dramatic peak in early 2024, followed by more normalized earnings levels around $1 to $2 billion per quarter in 2025. The 5-year compound annual growth rate for net income is a powerful 28.6%. This ability to consistently generate billions in profit allows Tesla to self-fund its massive capital expenditures without relying on external debt or equity raises. While net income has seen some recent year-over-year compression, with a 1-year decline of 63%, the overall trend since 2021 remains fundamentally different from the company's early history. For investors, the key is the sustainability of this profit floor. As Tesla continues to scale its production and software offerings, the market expects these bottom-line figures to re-accelerate and support the company's premium valuation in the coming years. Free cash flow is a critical measure of Tesla's ability to generate cash after all capital expenditures. The historical data reveals a company that has successfully moved past its cash-intensive early years. Since 2020, Tesla has generally maintained positive free cash flow, with several quarters exceeding $2 billion. While we saw a notable negative spike in early 2024, likely due to massive infrastructure investments and inventory shifts, the company quickly returned to positive territory, generating nearly $4 billion in the most recent reported quarter. This ability to generate real cash is what separates Tesla from almost every other EV-focused startup. For investors, positive free cash flow is the ultimate sign of financial health and independent scaling. It provides the firepower for future gigafactories, AI development, and the expansion of the supercharger network. The recent recovery in cash flow is a strong signal that management is regaining control over its working capital and operational efficiency after a period of heavy spend. The earnings per share, or EPS, chart mirrors the bottom line turnaround we've seen in the net income data. After a decade of negative EPS, Tesla broke into consistent profitability, with a massive spike in early 2024 reaching over $2 per share. Throughout 2025, EPS has normalized, generally sitting between 50 and 75 cents per quarter. The 5-year CAGR for EPS stands at 27.6%, a robust figure for a company of this scale. While the recent year-over-year decline in EPS has been a point of debate for Wall Street, the long-term upward staircase remains the defining feature of the chart. For investors, EPS is the primary driver of valuation multiples. The market is currently weighing this normalized earnings level against Tesla's future growth potential in autonomous driving and energy services. The fact that Tesla maintains positive and material EPS, even while continuing to invest heavily in its future, is a key pillar of its current market capitalization and investor confidence. Tesla's balance sheet strength is clearly visible in the cash and debt chart. The green bars, representing total cash, have grown dramatically over the last 5 years, recently peaking at over $40 billion. In contrast, the debt levels, shown in red, have remained relatively flat and much lower than the cash pile. This results in an incredibly strong net cash position, providing Tesla with a massive financial fortress. The capital lease obligations, shown in orange, also remain manageable. This rock-solid financial footing is a huge competitive advantage, allowing the company to navigate economic downturns or competitive wars from a position of strength. For investors, this chart is a signal of extreme stability. Tesla doesn't have the same debt burdens that plague many legacy automakers, giving it the flexibility to pivot its strategy, aggressively cut prices to gain market share, or make massive long-term bets on AI and robotics without jeopardizing its solvency. It is one of the cleanest balance sheets in the entire industrial sector. Finally, we look at where Tesla is deploying its capital. The expense chart shows that capital expenditures, or CAPEX, remain the dominant area of spend, frequently exceeding $2 billion per quarter. This highlights Tesla's ongoing commitment to building out its physical manufacturing and infrastructure base. Research and development, or R&D, also shows a steady upward trend, which is critical for maintaining its technological lead in AI and battery tech. In contrast, selling and management expenses have been well controlled, and G&A spend remains a smaller part of the total. Interestingly, while CAPEX saw a one-year decline of 13%, the five-year growth in infrastructure and R&D spending remains high at over 15% and 27% respectively. This expense profile shows a company that is prioritizing the building of long-term assets and future technology over immediate overhead. For investors, the focus on R&D and CAPEX is a bullish sign, indicating that management is still focused on the next decade of innovation rather than just managing for short-term margins. In conclusion, Tesla's latest financial data reveals a company that has successfully established a high-magnitude profit and cash flow baseline, backed by an incredibly strong balance sheet with over $40 billion in cash. While recent quarterly numbers show some normalization and compression compared to the 2024 peak, the long-term growth story in revenue, EBITDA, and R&D remains firmly in place. Tesla is no longer just an EV startup. It is a mature, cash-generating industrial and technology giant with the financial muscle to lead the global energy transition. Thank you for joining us for this extensive data breakdown. Don't forget to like, subscribe, and hit the notification bell so you never miss an institutional-grade analysis of the markets. We'll see you in the next video.